Good morning, everybody. Welcome to the Flow Show. We're here at Friday at last, over the hump of all the big central banks and sailing merrily along. Hope you're all doing well. Morning, Stel. Morning, Kay.
Morning, everybody.
Good morning, everybody. TGIF.
Yes,
Indeed,
how you doing?
Indeed.
Or TFIF, as I like to call it. I'll let you work out what the F is for.
All good here. All good. It's been a long week.
Right.
Many central banks, and like the guy on Police Academy would say, many central banks, yeah. So we have a lot to chat about.
Yeah, I'm all central banked out, I think, this week. I'm done. That's it for the year, apart from Bank of Japan next week. Yeah, definitely all central banked out.
But what happened in those, what was it, the elections that Kay was talking about? What was it, Zimbabwe elections? No, what was it?
Fiji made
Fiji elections.
Get your come on, still. There you disappoint me. Right?
Where should we start? I think we'll start with the data first, because there was obviously a ton of data out as well yesterday, right in the middle of the ECB, and quite significant data, really, particularly from the US. So, bit of numbers, jobless claims a bit the other way this time, lower. So we're not seeing still yet from these numbers, not seeing anything significant that's flashing any red flags. The 4-week average actually dropping to 227.25k, so down 3k there on that. Then we got the first manufacturing data of the month of December from the US. Empire State down 11.2 versus -1 expected and a positive prior. The Philly Fed also down worse than expected, although slight improvement over the month before, but still negative. The components of the Philly Fed aren't looking too good either. Employment negative, new orders worse, prices paid lower, and there was also prices received was lower as well. So looking very negative on that side, although there were some bright spots. Actual conditions at the moment, a small up, and capex actually rising. That's investment into machinery and bits and pieces like that. So that was a bit of an improvement there, but employment, inflation numbers all lower or worse. Retail sales disappointed as well, coming in, as we can see there, -0.6%, was expected to fall 0.1%. This comes in the month of November, which, as we know, is one of the big shopping period months. All the sales, Thanksgiving, Black Friday, Cyber Monday, so on and so forth. It's why we have to really take November and December together as a whole, because the old times used to just be December. That was the big retail month, Christmas and everything. But now, with the advent of online shopping and all these different sales, you have to take 2 months into account. So not a good start looking at those. Core sales, that's sales when you strip out all the fancy bits and bobs, came in negative as well. That's the control group there, so down -0.2% there. Then we had some industrial production, and again, soft numbers as well. So despite the fact that the Fed are going to continue raising and going to push on apparently to their new ceiling, the data is suggesting otherwise, and the market isn't buying into it. But we still saw a lot of dollar strength yesterday, which is coming in a bit of a surprise considering yields remain under pressure, as did stocks. So, you know, just maybe we're getting into some year-end stuff there now. We're over the big central banks. That was that from that data, that side. Just coming into this morning, if I get to the right page today. Some consumer confidence numbers, a bit better, but still looking negative from the UK, -42 there. It is PMI day today as well, and as we can see there, manufacturing a bit further into contraction from Japan, but an improvement on services. So a bit of a divergence there between manufacturing and services over there in Japan. Retail sales in the UK, another set of poor numbers coming in there. down 0.4% on the month. Core sales down 0.3%. Again, not looking good for the UK. Soft data coming in. PMI is coming through from the Eurozone as well. France, there you can see manufacturing, little better, still in contraction. Services, much worse there, going 48.1. Pretty similar, bit of a tick up in the German manufacturing numbers, but we're still in contraction, and the same for services. Could say it's maybe starting to move in the right direction, but I wouldn't read too much into it there. Same coming in for the UK, bit better on services. Manufacturing, however, even further into contraction. Final numbers, CPI numbers from the Eurozone and Italy as well. Nothing really a change, a tick up in the Eurozone, HICP to 10.1% from the 10% flash. Core number unchanged at 5%. So overall, the data there painting a sort of final picture as we head out of the year. Nothing really looking too positive on that front. So now let's get into some of the headlines. Start off with China. China and the US had a little chinwag. An ambassador and Treasury's Yellen agreed to step up coordination on trade and policies. The National Health Commission is stepping up COVID control and prevention in rural areas. They're going to increase reserves of essential drugs and home testing kits as that obviously those COVID cases sweep through. So let's start with some of the central banks now. Bank of England, they kicked things off yesterday morning. We said it was going to be a bit of a mess, and a bit of a mess it was. They voted 7-2 to increase rates versus the 9-0 that was expected. The two who didn't vote for hikes voted to keep rates unchanged. Within the 9, there were 6 that voted for a 50 pip hike, the 2 that voted for unchanged, and 1 voted for a 75 pip hike. We did get a couple of comments within the minutes and so forth on those reasons. Bank of England's Bailey said the latest MPC projections suggest CPI inflation has reached its peak, but it's expected to remain high in the coming months. So he's putting a call out that they see the top for inflation in the UK. Let's see how very high it does remain. BOE's man was the one who went for a 75 pip hike and said it was needed to lean against inflation psychology, and that price and wage pressures were greater than in November forecast. The two dissenters, if you want to call them, Temrero and Dingra, said that a 3% bank rate is more than sufficient to bring the CPI back to target, and there's no strong case to tighten on risk management grounds. They've been called a whole host of names and really been ruined in the press since they made their decision to keep rates unchanged. A lot of people looking at the CPI still running close to 11% and wondering how you could vote to keep rates unchanged. So it's really caused a bit of a palaver.
Brian?
The pound. Yes, mate?
Yeah, I have a question in regards to that. If those two, or Ingram at least, are seen like not being good enough to be on the board, can they be replaced during their mandate, or is that fixed? I have no idea. That's why I'm asking.
I don't believe so, because I don't see. It's only really the market that's calling them out on this. I mean, they could be perfectly right, and inflation could pull back. You know, we could have seen the peak, and then they don't want to hike too hard into a possible recession.
No, but I mean, away from the fact that, like, if they are seen like being doing like a bad job or so, is it possible to push them out, or is it just a fixed mandate and that's it? I'm just asking, because I don't know.
I don't know, to be honest. I think obviously if there's any cases of impropriety or anything like that,
that's a different
thing. I think this is a less than 1% chance of anything like that happening.
Yeah, who judges whether they're doing a bad job or not? It's probably down to Bailey.
Okay.
Plus, it's all. Remember, it's all debated and it's all, behind closed doors. So if anybody ever had an opinion that's really radical or whatever, it's going to be discussed first among them, right? And the chair is going to be, let's say, weeding out the really, really bad stuff. If somebody has any crazy opinions, I don't know, but I find it a completely improbable event.
Yeah.
You can ask Danny Blanchflower next time he's on with. You can stick that one on a post-it note for him.
The thing is, there's no right and wrong in economics. That's the thing, right?
Anybody
can have a strong argument for both sides with the same prevailing conditions, which is good and really bad. So, there you go.
Yeah, definitely. So anyway, so that's where we're at with the Bank of England. And if you look at cable, basically any pound pair, it's come off quite significantly. A lot of the market thinking that it was quite dovish from the Bank of England, calling a peak in rates potentially soon, peak in inflation. I think they may end up with egg on their face yet again. They're going to be underestimating how high inflation is going to stay up for and how long for. I still maintain, I think rates will still be going to at least 5%, but we shall see. So let's move on to the big one, the ECB, the one that some are calling the most important and significant ECB meeting since Draghi's do whatever it takes meeting.
Since the Second World War, right?
Yeah. Now I've had a chance to sleep on it. I mean, I said yesterday, I don't think it's as important at that meeting. They've really only just turned a bit more hawkish than they already were. I don't know why it's been made into such a big thing. The market, well, I do, because the market is always looking at the ECB through dovish eyes. And we know they've been hawkish. Well, we know Lagarde's been hawkish for several months now. We've been pointing it out week after week on here. I think now she's had to push that line a bit further to get the message through. And I think that the market's finally woken up to the fact that they're going to get a fairly hawkish ECB. And that was borne out in some of the comments that came from Lagarde. They said that the ECB needs to do more on rates than the market is pricing. She said it's obvious that we should expect 50 basis point hikes for a period of time, and that information predicates that 50 BPs should be happening at the next meeting, possibly the next one as well, and possibly thereafter. And she went on to stress a couple of times that 50 BP hikes should be coming for at least the next 3 meetings. Following that, we've had obviously the floodgates open on all the ECB bods coming out, jumping around and proclaiming what they should be doing. Straight after the meeting, we got the first sources, the usual sources, saying that the ECB faced a sizable push to favour a 75 BP hike. And as I say, then we've had EconoStream out with one of their insiders saying that the plan is clear to hike 50 pip meetings at least 3 times in a row. Ollie Rehn rates will have to rise significantly. Muller rates likely to rise more than market expects. Vilroy market rate expectations fell too far in November, but we must not speculate on the number of hikes. So the hawks have pretty much been the first out the nest. Overall, it has been hawkish. Let's not underestimate that. The market was well underpricing this. It's been forced to reprice all this now. So as you can imagine, rate expectations are going up, and obviously we've seen moves in the euro, and as you can see from the chart there, euro sterling has been one of the big beneficiaries from that. So guys, let's start with the Bank of England. Any clarity from it in your eyes?
For me, the Bank of England was dovish. Full stop. Two members voting for no change. I know it's a small minority, but it's still the beginning, right? I try to look for shifts in I don't want to say sentiment, but shifts in central bank action. And for me, even though they still hike 50, this for me is very dovish. And I've said before, remember what I said before the Bank of England yesterday? I said every chance they get, they're on the dovish side. That at least that's what the recent years have shown. And this was another one of those days. And if we have two now voting for no change, how many are we going to get next month when inflation starts dropping and you know, things start looking worse? You know, they're already, two of these members are already looking far ahead into the future and have decided that these rates are appropriate. Maybe more will do, you know. So for me, dovish.
For you, dovish. Just before you jump in, Kate, I just want to highlight this because this is one of the big kickers of yesterday and probably one of the big reasons behind the ECB going so hawkish. It's the latest staff projections, and this one is the main one. So they expect core inflation, so let alone headline inflation, which as we saw coming in at 10% today, 10.1%. They expect that 6.3% in 2023. The core, though, they expect to still see it up at 4.2%, well above their target. That's what they're acting on this time. We got that heads up from sources earlier the week that the forecasts are expected to jump up. And as you can see, they remain above target 2024 and 2025. And this is going to be the basis for what the ECB do through 2023. Just wanted to highlight that. Kay, your thoughts, mate?
Yeah, so I agree. It was a dovish hike by the Bank of England, and also I think what resonates is not only those dissenters, but Bailey's repeatedly warning about the situation not being good and expect downturns and the global situation in the UK not being good. I think it's a bit of combination where the market all of a sudden woke up, and then to add to that, then we got a hawkish ECB where Lagarde and her dovish guard had to give in to the hawks. Was a clear victory for the Germans, the Dutch, the Austrians, etc. And that added to the fact that euro sterling exploded. And I mean, it looks like, as I was saying yesterday, that was Lagarde's big catch up also on the FOMC. And even though they will remain far below US yields, but it seems like the market finally woke up to what we have already, and you have been saying, Ryan, for a while, is this catch-up move of the ECB, and now it's really there. That was Lagarde's Christmas show, right? And she gave the market the green light to buy euros, basically. Well, I mean, against the dollar is a different thing, because there's still like this the interest rate divergence playing in favor somewhere of the dollar, but it's all pointing at risks, and we know that sterling doesn't usually not do that well in a risk-off environment as well. So it's a whole host of things, and we said at the beginning of the week we'll have to look through all those CBs and then make our judgment on what's happening. And I think the market is showing what the judgment is, and that's sterling is not feeling well. The euro is doing well through the crosses. The only thing, and on the euro, and Gavin also notes it in the chat, is that we'll have to pay attention to the spread, to the peripheral spreads now, because that could be somewhere a little drag on the euro if those spreads start to go out, because the ECB is going to raise and raise, and the peripherals having to worry about their how to repay debt and stuff. That could be a worry, but for the time being, the market isn't trading it, even though the spreads are widening already. I think take everything into account. It was a hawkish ECB versus basically the rest of the field, right?
Yeah, exactly.
And now the rest, and that's going to be the kicker, or the I'm not saying the difficult part, but that's going to be the price action further on, is data. What are data going to tell us? Like, of course, the inflation, but also real data. And I've been hammering on that. I mean, to get soft landings left, right, and center, we're going to have to see the data hold up or not completely collapse. If you see a mild recession, a mild coming down of the data, okay. But if from here we are seeing data materially weaken and stay weakened, that's where the soft landing and mild recession picture can deteriorate relatively quickly. So that's about my view now on things. And I was long quite a few euro crosses. Now I reduced a lot of them, but the euro sterling is still something I quite like for now.
Yeah. So really, yeah, you're right, Kay. I mean, it's going to be a question of monitoring, you know, now where the ECB's at, what it's going to do with rates. They've highlighted pumped 3 rates over the next 3 meetings. So much for not pre-committing to rate moves, as has been their line for, you know, forever. Now they're giving us, you know, potentially 3 hikes on the spin. It's done the job of getting the market repricing. That'll affect, as we saw from the US, it's going to affect mortgage rates. It's going to affect everything on the ground. But it's going to then become the same question as the Fed, is how high will ECB rates go? So we're going to start pricing in some sort of ceiling, like we do with the Fed. And, you know, this is why we look at all this stuff with central banks, because we can use the template for the Fed for the ECB. You know, we know the market is having this little hawkish moment now. Then it's going to be looking at the data and thinking, right, well, can the ECB do 3 hikes? Can it get to whatever ceiling it's going to go to? Or is the data going to turn? And we're going to play the same old game with the ECB as we're going to play with the Fed. We've already done it with the Fed. Now we're doing it with the ECB. So you know what to expect. You know how to trade this going forward. As Kay says, what's the data? If the data's coming in stronger, fine, we're getting up there. If the data's coming in weaker, then maybe not. You know, and again, that could be significant on things like forecast, because they're actually forecasting the economy to contract by 0.6% next year. And I'll see if I can get that chart up again. You know, so they're effectively going to be hiking into what they see as a confirmed recession. They're expecting a recession to come next year, but they're going to keep hiking anyway. So bit of a difference potentially to the Fed, where the Fed isn't recognizing officially a recession. They're saying things could get a bit weaker, but they're not really wholly putting it in black and white. The only difference we have with trying to monitor a ceiling, you know, we'd look at US 2 years. That's been our rough guideline for where the Fed may park rates up. It's different for the Eurozone because we've got obviously so many different countries, so many different yields, differences between Germany and higher risk countries like Italy and our friends in Greece. You know, so it's going to be a bit difficult to monitor, you know, where levels are going. You know, Italy's two years are up in the, you know, 3.2% mark. You know, Spain 2.75. You know, wherever you look, Greece. Oh, I'm surprised they're not 10% now, but you know, that's what we're going to be looking at. So it's going to be a bit more difficult to watch the pricing for a ceiling, but there are metrics we can look at as we do before, and we'll throw those out for you now. But what are the price moves? You know, it has been a bit of a strange one. There has been a lot of dollar strength. You know, we saw euro dollar rocketing right up into the 107s, but we're all the way back down in the low 106s again. So it hasn't really held its gains. It hasn't, you know, taken off and kept going, a bit like euro sterling has. I think we're seeing a lot of potential year-end stuff coming in, and it's looking like the dollar is the currency of choice for buying for that. Alternatively, you know, we saw a really strong move in the dollar yesterday morning before the ECB, and potentially the dollar is now back being a risk-off currency, which will change the picture a bit. You know, here we are getting all the way up 138s again. But at the moment, we're not holding it. So the picture for me is a little bit unclear what's going on with the dollar right now, because as we say, we saw this big move coming in the last couple of days, but then you look at yields come to the 2-year and it's not doing an awful lot. Look at the 10-year, still mooching around that 3.5% mark. So no big move there as to why the dollar should shoot higher. So when you see the dollar moving or any currency moving, but you check the other little metrics that you look around and they're not moving as well, then you've got to start asking a question, why is this moving? So what are your thoughts, Kay? Why was the dollar so strong yesterday when the data was bad, yields were holding softer, and there seemed no reason for it to be rallying?
No, I think a lot of that had to do with the stocks coming off, no, and the dollar being bought, and then also there were some decent technical levels up there, right? The test above 107 on the euro, the cable, and we showed that on the Aussie dollar as well, the Kiwi dollar, you name it. There were a lot of dollar pairs, and perhaps the weaker dollar had been traded into and over the FOMC, and then market decides to take profit, and then all of a sudden sees, oh, we need to buy dollars because of the equity markets are coming off. I think it's a lot. It's a combination of a lot of things, and also the fact that Powell or the FOMC, they didn't tell us they were going to cut rates or they told us they will slow down, but they didn't tell us they will cut rates anytime soon, and the fight isn't over. So I think it's really a combination of factors that the dollar was so strong. But if you look at really across the spectrum, it's really a risk play. Apart from the yen, the yen is a bit, and I think that's because of the BOJ upcoming and people thinking that they still won't move anything. So that's a pure yield differential. And I think a lot of euro yen has been bought yesterday, so that dragged dollar yen up. But dollar yen decoupled from the yields for a good while, right? Yesterday, well, for yesterday at least. But now that we've seen the dollar yen move, it's still capped around 138, right? So the range there is still, I would call it intact for now, with 138-ish as the top side of the recent range. You can see that we have bottoms there, we have a few tops there, and that is still broadly respected. There may have been some short-term stops being done there above 138 because of the violence of the euro yen, but I think the dollar yen is still rangy, and we will see after the BOJ what's really happening to dollar yen. But yeah, the rest of the dollars, I think it's a lot to do with risk off.
Yeah, I think that's the case too. Yeah, it's definitely.
And I'm going to have to leave you guys.
Yep. You go, mate.
If I may add one thing about the dollar, see you, Kay.
See you guys. Have a great weekend.
One thing which is interesting is that the market did not change any of its pricing regarding what the terminal rate is going to be for the Fed and how long it's going to stay. So basically, the whole of the strip of the Fed fund futures was pretty much unchanged. So we're still pricing a little bit under 5% for a terminal rate. It stays there for 2-3 months and it starts dropping. So why would the dollar rally, given that rate expectations haven't changed? And I have to agree 100% with what Kay said and what you said about it being an equity move. And then we know the usual knee-jerk reaction, buy the dollar and sell the crap out of metals. So so this is just a knee-jerk reaction to equities going lower. Now, the other thing is, I wrote a blog post yesterday about the post FOMC and ECB and Bank of England landscape, a very short post, but I said in the end, I said, look, I think we will probably continue with this kind of risk-off theme, dollar going a little bit higher, and into year end, maybe into early next year. There is the Santa Claus rally, which might offset that, but I think that's what we're going to get, and this is what we're getting again today. So more risk-off, more. Actually, the dollar is not going up today, but you know, it's been strong since yesterday, and I don't want to get in front of this. Not yet.
No.
I think the time will come when the dollar is going to be retreating. And look, the ECB was more hawkish than expected. They're telling us they're going to do 3 more 50 hikes. I doubt that. I really do. But that's what they're telling us. So at some point, the euro is going to start outperforming, and the dollar is going to start underperforming. So double whammy for the euro dollar, I think. But first, I think the dollar is going to probably continue a little bit further to the upside. I wouldn't get too hasty in getting ahead of this move.
No, and Mike raises a good point. There's also a very big OPEX, you know, big end of year one coming in later. You know, that's probably what we've been starting to see in stocks, because they really are looking ugly at the moment. So you've got to factor this in, you know, and we said it all earlier this week and last week. You've got to take this week and after the central banks in 2 parts. So we've had all the central bank stuff. We know where they're at now. Okay, we know what the Fed's doing. We know what the ECB's doing. We know what the Bank of England's doing. So when you look at the fundamentals, we're just going to be watching the data. Does it marry up with what the central banks are saying? And that's going to be the underlying current for everything moving forward. So where we're at now is you've got to take a snapshot and take that into the new year. From now, today, next week, we're trading OPEX stuff today. We're trading year-end stuff. There may be moves that are well out of sync with the fundamentals and the central bank stuff. We don't know what it's going to be. You know, we could see the dollar at 140 in versus the yen. We could see it at 135. The same could be said for any pair. This is a time of year where you've got to be careful. Moves may not make sense. The narratives may change day to day. Like now, we're seeing the dollar bid on risk rather than bid on yields. So it does become a bit messy. So all you do is you have to go to your charts and you have to look at your levels. And you ask a simple question. If you see a move that's big and you think, right, I'm going to fight this stock move, like in the S&P here, well, where are you going to fight it? You know, pick your battlegrounds. Don't just think, oh, I think it's gone far enough, I'm going to buy it, because that's when you get stuck in a stupid trade that goes against you and you're sitting offside for ages, and then you're asking, well, where do I get out? You know, pick your battlegrounds. If you want to wait for a bigger move, you know, the 38 handle into this old fib down here, you know, that's been an on-off support and resistance area. That's where you may say, right, I'm gonna try and fight this. You know, your risk under 38, the big figure, you're wrong. So you don't need to put big risk in it. You don't need to get to 37.60 and think, oh shit, what do I do now? Okay, you're wrong. If 3800 breaks, you're wrong. There you get out. Pick your levels. So if you get, this is a time of the year where you should be scaling down your trading anyway. If you've made good money, you don't want to blow it all in the last week of the year. But if you're going to fight stuff, then pick your battlegrounds. You know, I was looking at Aussie dollar. You know, I'm long this one. I wanted to see a nice strong close come today. I wanted to see us well above the 68 handle, and we were sailing pretty above the 68 handle. But have we kept it? No. In the space of a couple of days, we're now testing the major support, in my opinion. You know, this is the support for this whole trend that we've seen going back since November. So I'm not going to get a close this week above 68, I don't think. That means everything moving forward, it's hard work again. When we come back into the new year, I'm going to be thinking, what happens now? Can we really get above this 68 level and push on? I thought we were doing it up here. Well, here we are testing support. If you're not been long here, if you've been worried that you've missed all that move, well, this is maybe the area you give a go to. But if you break under this zone, likely we're going to see more significant drop. So you're going to be wrong. You don't need to risk a lot. There's a 20 pip zone here, 60, 65 to 80, 15 pip zone. You know, 20 pips under, you're wrong. But if you think that this move is, if you think the Aussie dollar's gone too far in this move, if you don't believe that it can go further down, well, you can have a short risk, a low risk trade trying that fact. But don't be just buying it and thinking, right, well, then we get to 66.30. What do I do next? Pick your battlegrounds. Kay, Okay, Stel, do you want to? You're going to set up some charts for.
Yes, and by the way, one more thing I wanted to mention before I do that. People ask questions on the chat, and what about this? What about that? There's a lot of things we don't discuss. We don't have the time to discuss here and mention and do so. And we do all that in our chat room. So we can't cover everything. We already cover loads of stuff. I mean, Ryan does an amazing job, but a lot more details on a lot more things, trades we talk about in the chat room. So, come join us. It's a nice place to be.
Yeah, definitely.
Okay, so desktop one.
Yeah, you got it.
I got it. So, for me, the big event post FOMC has been yields, and yields have been going sideways. Yes, we are respecting in the 10-year this 340. 342, whatever it is, low. And that, as I wrote on my original blog, on my blog post from yesterday, excuse me, that is do or die for bond bears. If you bearish bonds, you need to see that hold. If that goes, then everything is changed. But for now, it's holding. But as I said before, Fed Fund futures are not pricing anything different than they were, say, 2-3 days ago. So it looks like the market is still not believing the Fed. The Fed, the dot plot is giving us a terminal rate of just above 5%. So it's not that far away, right? It's less than a quarter of a basis point. So I would say that the market is more or less fairly priced. Okay, maybe underpricing a little bit, but any surprise on this at this point going forward, I think is going to be on the dovish side. And why do I think that? Because I think that economic data is going to start disappointing, and I think inflation is going to start dropping fast as we get to February, March, April of next year. And I'm guessing that the Fed and the ECB they're thinking along the same lines, I'm guessing, but they have to continue with a rhetoric that says that we need to fight inflation. And inflation, as a snapshot today, is still high. We have started to go down, and inflation is dropping, and in decent chunks as well. Not just in the US. We had the Eurozone CPI today, which was down, I think, 0.5%. It's still, as absolute levels, it's still high, but what you want to see and what the central banks want to see is a change in the trend. And then they can forecast, 12 to 24 months forward, what's going to happen with current monetary conditions and monetary policy. So going back to charts, 10-year US, huge level, 340, 342, needs to hold. Otherwise, we're going a lot lower. We're going to 320, which is the 61.8 retracement of the August lows to the October highs. And there's also the 200 DMA, which is around there at the moment. So there's going to be some pretty decent support there in yields if we break lower. But that's how we are now. And as we see risk off happening, I've said before, I think we're going to continue going into year end and possibly early next year. So look at the S&P, 1, 2, 3, 4 touches. We did have a momentary break above, but we didn't close above on a daily basis. This was the CPI. And this must have taken a lot of people the wrong side here. I mean, this was, if you look at like a 4-hour, this was, big trap. So everybody who got long here is completely out. And if they haven't bailed yet, they really should be. We are toying with the 50 DMA, but I think we're going lower. I think, honestly, I think we're going to be testing these lows around, maybe not the spike low, but 3,600, I think is the next target in the S&P. Similar levels in the NASDAQ and the DAX. I'm not going to go into each index, but we have respected this trend line resistance, and we are continuing lower. Obviously, if there's any unforeseen event that causes risk on for any reason, yes, of course, we could see a bounce, but all else unchanged, I think this is going to continue to the downside. The dollar is.
Do you think there was too many eyeballs on that 42 level in S&P?
Yes, there was, but
the world and his mate was waiting there. So
yes,
was it surprised that we didn't get up there?
Yeah, I mean, there were too many people talking about 42. Remember, we had been talking about 40, 50 to 4100, and I mean that was nice. But yeah, I agree with you 100%. The dollar is trying to bounce. It's not. I mean, if you zoom out, it's still a pretty feeble attempt at the moment. I think we could move back towards the 200 DMA, which is going to be around 106. That should coincide with risk off that I think will continue. You know, obviously this is just what I think is going to happen. I can't be sure. If I was sure, I'd be a trillionaire. Yeah, this the 50 DMA is coming lower. The 200 DMA is going a little bit higher. So, you know, I think around 106, maybe 106 and change will be a nice level for a reversal. I also think euro dollar has upside, maybe not immediately, because as I said, I think the DXY is going to go higher in the short term. So, you know, 50% of the DXY is the euro dollar. I think we're going to go back down towards the 104s ish. But I think it has upside on policy divergence and on inflation going lower. Remember, I've said it in the past. I think it's still the case. I think the Fed and the US economy, they are leading. And we're seeing a lag. We saw that with inflation. The Fed, the US inflation ticked up first, started going up, and then Eurozone followed, and UK and everybody else. I think the US inflation is going to start dropping first, and I think the Fed basically is going to start acting first. So as they usually do, you know, they're usually ahead of the curve in pretty much everything. So I think we're going to see 104s in the euro dollar, and then we spike up towards God knows where. I really don't know. I need to pull up some fibs here, but yeah, I don't know. I don't want to speculate this time. The pound is weak. We caught that nicely on face yesterday. I think a couple of a few of our members also took the euro pound long, and this was an amazing candle. And I think we have further to go. I'm not going to go in a straight line, but I think this 88.2, these highs, that's the next target. So another 100, I think the next 100 pips are to the upside. And again, this is on central bank policy divergence. I think the Bank of England was a lot more dovish than expected. I really didn't. I was actually debating within me. I thought it was a low chance, but I was debating, is it going to be a 50 or a 75? And I said, I thought in the end, I said on here and on Faces, no, they're not going to be doing anything different to the Fed. 50 is done, and we see. But, you know, with two people being, you know, voting for no change, it's unbelievable. So the pound, I am bearish a pound, especially against the euro. I will be bearish. Well, actually, no, I don't know. Maybe in the short term against the dollar as well, cable, because I think the dollar is going to strengthen. But after that, the dollar, I don't like being long the dollar afterwards, so I'm going to avoid the cable. Dollar Norway is one I like. I would love this to come up towards 10.15. It's going to be like a confluence of this descending trendline resistance and 50% fib from the previous move. So I like that. There are a couple of pairs that I like to monitor, and but I want to pick levels and I wait for the price to come to me. If it doesn't, well, it doesn't. You know, let's move on. Metals, gold is doing okay. You know, we had the down day yesterday, but look, it's still fighting. I think as long as we get risk off, it's going to be difficult for metals to avoid going lower. But I must say, gold is strong, and it's toying here with the 200 DMA. We're in a range, in a zone here of interest from way back. So you know, I am bullish in the medium term. Obviously, you guys know that. But in the short term, with risk off and with the dollar going a little bit higher, I find it hard to see how metals are going to outperform. So yeah. So gold is trying to hold at these levels. 1735 is really the big level. We've talked about it, 1730 to 1735. Talked about it a lot. If that breaks, goodbye. I think we're going back to not even 1680. I think we're going back to these lows here, 1620. But for now, 1730, 1735 is the level. Silver is doing worse as expected. It moves a lot more, and it is an industrial metal. It tends to go with risk. Was down 2.5% yesterday, another 1% today. Trying to find support here on this kind of channel. Used to be resistance, now support. Yeah, with risk off, I don't think this is going to hold. I do have a long position. I don't want to. One of our friends yesterday asked on the morning edge, why don't you get rid of your longs? I'm well in the money. I said I always want to have a little bit of a long, because if the move starts properly, I don't want to be out of it. I want to be a part of it. But my position is just under half the position size I want to have. So I'm looking to add. And the first level is 2210. These previous highs, lows here, 2210. I think that's a level of interest where I'm going to probably add a little bit, depending on how risk is going. And then we have a big area around 21. So those are the levels I'm looking at. And I want to get full size long on this, but I'm not doing it just yet. Cryptos, we didn't talk about cryptos. This, you can never be exactly right. Some kind of a flag, whatever that you want to call that, I don't care. But zoom out and look. I
call it a mess.
A mess, yeah. Look at this. This is... I don't know. It just looks like death to me. And if risk off continues, if equities keep selling, these lows were about $1,500 away. They're going to go. It has been, I must admit, it has been fighting pretty hard not to break these lows. But I don't see how it's going to avoid that. You need a broad market rally for cryptos to rally. And there's been more and more talk about regulation and, the contagion from FTX. Is it over? Of course not. I don't think so. These all are all interconnected. They're lending each other tokens and this and that. And, we've seen it play out so many times in the past year with Celsius and FTX and the other names that I keep forgetting. Ethereum is a similar story. Obviously, the moves in Ethereum are a lot bigger in both ways than Bitcoin. Like it's 2 times. So it's down 4% today. Again, similar story with Bitcoin. I really don't see it holding. Sorry, crypto bulls. I am not touching this. I will get long Bitcoin. I know. It sounds like craziness. But if and when we get to this 12 to 13K level, I think I'm going to, buy one Bitcoin or something like that, just to have some interest in it, on a technical level, and for a trade. Nothing to do with Bitcoin's dominance in terms of fiat currencies in the future, etc.
I'll do you a favor, still. You buy it 12 grand, and I'll buy it off you for a $5 12 months later.
Yeah, I think Bitcoin is here to stay as a collectible, if anything. But as long as transactions are not done for buying stuff, I read somewhere less than 1% of global transactions are of global Bitcoin being bought and sold is for buying things, and that's supposed to be its primary reason for existence. So yeah, let's see. Okay, yeah. That's all I had to show. I don't have much else. We'll pick it up on Monday and see how markets are doing then.
Yeah, definitely, mate. I just want to answer one question of Martin asking about dollar yen. Can we see the 130 level? Not sure what you've got down at 130. Technically, can we see it? Well, talking my book, I'd like to see it because I'm short and happy to build shorts in this one. We have got some big levels. Look, taking a nice clean screen now. We've got this big 133 area. That's at the moment is going to be really big. We got down close to it in the big sell-off, but couldn't even get into those fibs there. So it is already showing up to be a big area. That's going to be a big one. If we break there, there's every chance we can see 130. And if we have a little bit of a more closer look at it, if if I can zoom in there a bit, you know, the levels are there to be seen. We've got this other big level here down at 131, call it 131, 30, 40. It was a big resistance point on the way up, and then became a support point on the way down. So there's several levels there. 130 doesn't look to be that significant in itself. That 131 seems to be more. So, you know, if we bust that, 130 is probably going to go pretty quickly after. But can we see it? Yeah, of course we can see it. We can also see it going back to 150. It all depends on how things play out next year. So one to keep an eye on. We trade the levels. We know where we're wrong. I like to think I'm US dollar bearish, have been for a while, as you know, but I know where I'm going to be wrong by looking at the levels. And on that front, as Stell mentioned, yep, the flow show will be here next week. Only the Monday and Tuesday, because then the family stuff starts kicking in and things start slowing down. So we'll be here Monday and we'll be here Tuesday to look at the Bank of Japan in case there's any fireworks there. But from then on, we're going to be shutting it down until the new year.
Yeah, so we're gonna be drunk from pretty much Wednesday onwards. So you don't want to hear us.
You're lucky we're doing it Monday and Tuesday. I'll give you that. But all the other shows will be going on Face and everything else. Obviously, we'll just condense down what you're not getting from the Flow show into the Face webinars and the other things there. So, yeah. But if you are leaving us this week, if that's enough for you, you've had a busy week, had a good week, good year. I hope so. Do have a safe and happy Christmas, holidays, whatever you're doing. Be good with your family, enjoy the time off, get a bit of a refresher. And otherwise, those of you who I know like to stick to the screens until the very last second, we will see you all on Monday. Have a great weekend all. Thanks, Stell. I'll give thanks to Kay when I see him a bit later for lunch.
Thank you, Ryan. Thank you. And I just want to say thank you, Ryan, for being here and doing this at the Flow Show every day. I mean, your coverage is absolutely incredible. I must
Thank you, mate. Thank you very much, mate. I won't get my head out the door now. It's always a pleasure.
Good stuff.
Have a good one, everybody. See you all next week.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.